Hello, I'm David Frazier with Investors Monitor, and this is our daily morning market prep show where we strive to tell you everything that you need to know, but nothing more, regarding factors and developments that are likely to impact the value of your financial market portfolios. Well, yesterday on Wednesday, September the 9th, I told you early in the morning that futures contracts on the major U.S. stock market indices indicated that stock prices in general in the United States would likely open up fairly sharply on Wednesday morning, but that my research indicated that stocks in general, as measured by the market indices, would probably peak during the first hour of trading on Wednesday and then pull back throughout the remainder of the day. And that's exactly what happened. And this came as no surprise whatsoever to me. And the reason being is if you looked at the trading action in the financial markets, in the U.S. stock market, I guess to be specific, over the past couple of weeks, you'll find that there was some significant price resistance, not up substantially higher than where the major stock market indices had closed on Tuesday of this week. And given that the economic environment here in the United States and abroad looks as if it's going to slow over the next few months, even though I heard some very well-known, highly paid executive this morning say on a major financial broadcast show that the U.S. economy is continuing to improve. Well, I don't know if that guy was completely inept or if he's just misleading people. I don't have a clue. But the U.S. economy is not continuing to improve. You know, I've told you over the past couple of weeks that a large and increasing number of economic statistics, and especially leading economic indicators, suggest that the U.S. economy is going to weaken somewhat over the next few months. No indication that we're going to go into a recession, but it is a good chance we're going to see a slowdown. So looking at not just fundamental economic and geopolitical developments and factors, but also keeping a close eye on the trading action in financial markets around the globe, it was pretty clear to me that once again that stocks were going to open up fairly sharply yesterday morning, but then pull back through the remainder of the day. And that's exactly what happened. Now, however, I readily admit that I did not expect the major U.S. stock market indices to close substantially lower yesterday. But that's exactly what they did. The Dow Jones Industrial Average was down 239 points on Wednesday, which is approximately 1.5%. The S&P 500 index was down approximately 1.4%. And the NASDAQ Composite Index was down approximately 1.2%. And today on Thursday, September 10th, futures trading here in the U.S. indicates that U.S. stocks in general, once again as measured by the major stock market indices, will likely move a bit lower again today. I don't think we're going to see any substantial downturn today, but it does look as if stocks will move a bit lower again today. Having said that, I guess I'll say what I often say to my business partner: the show must go on. And what I mean by that is if you listened to folks on the major financial broadcast TV shows on Wednesday evening or early this morning on Thursday, September 10th, here we go again. The latest downturn in stocks was all due to Apple. It was all due to a 1.9% decline in Apple because apparently their new products are disappointing investors, and people are losing some faith in Apple. So the Dow Jones Industrial Average was down 239 points because of a drop of 1.9% drop in one stock. Just think how completely foolish and idiotic that sounds. That's ridiculous. Of course stocks were not down in general just because one company's stock happened to be down. That is complete nonsense. What is really going on here, and what you need or should be aware of, and you can choose to be aware of whatever you choose, but what you should be aware of, whether you're an individual investor, one of our small hedge fund clients, or one of our registered investment advisory clients, or simply just a financial market participant that goes to our website and reads our commentaries and likes watching our show and does so on a regular basis. Regardless of who you are, I guess unless you're a sell-side analyst or stockbroker, that is one of those folks that try to keep you in the stock market at all times so that they can make more money. Unless you're one of those persons, I encourage you to stop listening to this complete nonsense that's often put out by sell-side analysts, that is economists and stock and bond analysts at brokerage firms, as well as folks that are employed by, work for, or analysts and portfolio managers for pension funds, insurance companies, and mutual funds. Folks that tend to want to keep you in the market at all times so that they can get paid well. Unless you're one of those persons, I encourage you to stop listening to this nonsense, because stocks did not fall considerably yesterday because of a drop in one stock, and they have not done so over the past few weeks because of what's going on in China. This is complete nonsense. What's going on here, or which I don't know what's going on. No one knows what's going on, but what a significant amount of data indicates is going on is that institutional investors, even though they're telling individuals and anyone that would listen to stay fully invested, everything's going to be fine, well, I don't know about a large, but an important number of statistics indicate that those same institutional investors have been selling large blocks of stocks over actually the past couple months, that they've gotten much more defensive in their portfolio allocations regarding the stock market, meaning that they have reduced their holdings in cyclical and growth stocks and increased their allocations to so-called defensive stocks, that is, stocks of companies that do not go down as much as stock prices in general during the stock market pullback. That they've been allocating more money to those defensive type stocks, getting out of growth and cyclical stocks, and that they added substantial amounts of their funds to money market funds over the past few months. That is, to cash-like investments. So that's what's going on here. These large institutional investors have been selling in to any of these rallies that we're seeing. So anyway, well, I guess I've said enough about that. So let's move on. Regarding important economic statistics that were released today on Thursday, September 10th, there were not any significant economic statistics released from the U.S. However, and there really were very few important economic statistics released from any other country around the world. However, China reported today that producer prices in China declined by 5.9% during August as compared to the same month a year ago. And if we look at inflation statistics from around the globe, we'll see that there's been very, very, very little inflation over the past few months, and really over the past couple of years. Here in the United States, for example, the Consumer Price Index, which is an index that shows what a general basket of goods and services, the change in prices in a general basket of various goods and services. This Consumer Price Index for the United States was up 0.2% during July as compared to the same month a year ago. And we see similar statistics from around the globe. We see deflation in certain parts of the globe. And this is something else that also comes as no surprise whatsoever to me. I mean, I was in a Las Vegas at a major event during mid-2008, and I was part of a panel that was asked by, that was presented to hundreds of investors and financial market participants. And there was a question raised to the panel, what do you think about inflation? Is inflation going to be a problem? And except for myself, all four of the other persons that were on that panel said, oh yeah, there was going to be huge inflation problems in the U.S. over the ensuing years. And they all said the reason behind it was massive money printing by the Fed. Well, money printing does not cause inflation, and I don't want to get into a lecture here on what causes inflation. That's not what this show is about. If you have any interest whatsoever, I encourage you to go to our internet website at www.investorsmonitor.com. Put your mouse over the individual investor menu item. You'll see a drop-down menu for something about education. I think there is a menu link, and you'll see something. You'll see some articles that I've written recently for another firm, and it'll discuss that money printing and how that's not what causes inflation. Anyway, enough about that. The fact of the matter is, inflation, in fact, has not been a problem over the past few years. Quite the contrary, if anything, we've had deflation. And unlike most people who, many people said gold was going to $2,500 or even $5,000 an ounce. Gasoline prices were going to go to $6 a gallon. This is what we heard during 2008. We're going to have massive inflation. Well, we have not. We've had quite the contrary. And because I do a heck of a lot of research, I advised our firm's clients to sell gold short via an inverse gold fund during mid-2011. And since then, gold prices in general, that is the spot price of gold, is down approximately 42% as of yesterday's close. And persons who followed my advice that sold gold short, well, their position in that inverse gold fund are up about 42%. Now, this is not to praise myself either. That's not what this is about. What I'm trying to suggest to you, the reason I bring that up is, there's many times I'm going to tell you something different than what you'll hear in the mainstream media. And it's not because I'm trying to be contrary. I could not care less about being contrary. It's not because I'm a bearish, perennial bear. That's not why I'm negative right now. I've been bullish many times during the past. Got bullish in early 2009, right before stock prices around the globe bottomed, or at least in the United States. It's not about that at all. What it's about is this show is about truly trying to help people that watch our show and to help our clients to avoid the big downturns and to profit from the big upturns in the financial markets. So all you're going to ever get out of us are comments on the facts. So that's really all that I have to say today. If you're not watching this show at our internet website, I encourage you to go to our site, once again at www.investorsmonitor.com, and sign up for our free weekly commentary. Won't cost you a penny. All you need to do is put in your name and email address, no credit card information, and we'll keep you updated on the factors that matter, the factors that are likely to impact your financial market portfolios going forward, not in the past. We don't care about what's already happened. So I thank you for listening and watching, and I look forward to speaking with you again on Friday. Thank you.